Iran has announced plans to offer its own insurance for vessels transiting the Strait of Hormuz. You clicked because this sounds like a breakthrough solution to one of global trade's most dangerous choke points. The real problem is that accepting this policy would not protect your cargo. It would hand control of international waters to a hostile regime and shatter the unified Western Front on maritime security. By watching this, you will understand why this offer is a strategic trap designed to fracture alliances rather than a viable financial product, and how it exploits the very logic that keeps global trade moving today. To grasp the stakes, we must first look at what happens when conflict erupts in the Gulf. The insurance market operates on a simple but brutal principle of risk pricing. When coordinated kinetic actions are threatened or occur near the Strait of Hormuz, commercial war risk premiums surge dramatically. Research indicates that these rates can jump fivefold within hours of escalating tensions. Major global insurers do not simply raise prices, they terminate coverage entirely for vessels entering designated conflict zones because the potential loss exceeds their capacity to underwrite it. In a full-scale disruption scenario, this reaction causes major carriers to demand rates 60 times higher than normal or refuse transit altogether. The result is an effective collapse of tanker traffic by over 80% without any physical blockade being established at all. This mechanism proves that commercial risk logic is already weaponized against the flow of energy resources in the region. Iran's proposed insurance scheme attempts to bypass this natural market barrier, but it does so by exploiting a fundamental weakness known as the tragedy of the commons within global maritime risk pools. The system relies on shared reinsurance capacity spread across London, New York, and Tokyo to absorb catastrophic losses that no single company could handle alone. By proposing a state-backed entity from Tehran to underwrite this risk, Iran is attempting to internalize systemic geopolitical risk that commercial actuaries have correctly priced as uninsurable due to the complete lack of reinsurance capacity within their own system. They are offering a product that has no financial backing for the very event it claims to cover: total war in the Strait. Quick resource note: I keep a curated set of Amazon search links in the description for books, gear, and tools relevant to this channel's topics. Some are affiliate links, so I may earn a commission at no extra cost to you. Please consider supporting the channel by using those links if you find something useful. The strategic bluff relies on forcing Western insurers and shipping nations into what we can call a regulatory trap. If a commercial carrier accepts an Iranian policy, they inadvertently validate the blocking entity's sovereignty over international waters. This shifts the legal burden of proof from the aggressor who is threatening the blockade to the neutral carrier attempting to transit those same waters. Under current international norms, Iran has no right to dictate terms for passage through these global commons. However, by purchasing their insurance, a shipping company would effectively acknowledge Tehran's jurisdiction over that stretch of water. This creates a dangerous precedent where hostile actions are legitimized simply because they were priced into an official policy document. From a systems architecture perspective, the plan attempts to bypass the trust anchor of the international insurance market, which is Lloyd's Joint War Committee in London. That body acts as the central clearinghouse that determines when a zone is too dangerous for standard commercial rates and mandates special coverage or total avoidance. The Iranian proposal tries to replace this decentralized network with a single point of failure: the state itself. If any carrier attempts to underwrite risk without sovereign backing from Tehran, they face immediate liquidity collapse because there is no mechanism to pay out claims if the strait closes permanently due to war. This leads us to the most critical insight regarding why this offer cannot work as advertised. The real cost of acceptance is not the premium payment itself, but the systemic collapse of the Lloyd's Joint War Committee conflict zone designation. This committee currently acts as the only barrier preventing total closure of the strait because it provides a standardized framework that allows ships to operate at adjusted rates while maintaining the threat of sanctions against those who block passage. If Iran successfully forces individual nations or shipping lines into their own insurance scheme, they dismantle this unified front. The global market would be forced to rely on a state actor with no reinsurance capacity and no history of honoring claims during periods of high conflict. The failure mode of this strategy is not financial insolvency for the Iranian regime in the short term. It is alliance fragmentation. By creating a scenario where individual shipping nations must choose between national economic survival and collective security pacts, Iran achieves more than any kinetic blockade could ever hope to accomplish. When Greece or Italy decides that their own ships need protection from Tehran rather than relying on London's framework, they are effectively breaking the chain of command in Western maritime strategy. This dynamic is far more effective for Iran because it turns the global supply chain into a collection of independent actors competing against each other rather than a unified bloc resisting aggression. Consider the moral hazard this creates for the entire industry. Accepting the offer incentivizes the aggressor to maintain a perpetual state of controlled chaos. If Tehran can collect premiums on every ship that transits, they have no financial incentive to de-escalate or ensure safe passage. They are paid to keep the threat level high enough to justify their existence as an underwriter, but low enough to allow traffic flow. This creates a feedback loop where stability is impossible because chaos is profitable for the regime offering the insurance. The only way out of this trap requires recognizing that commercial risk logic cannot be overridden by political decree. No amount of state capital can substitute for global reinsurance capacity when the underlying asset class, global oil transit, is under existential threat from a nuclear-armed adversary with no history of honoring international obligations during wartime. The moment a major shipping line signs on to this Iranian policy, they validate the regime's claim that it controls the strait and that its word is binding in international law. That validation is worth more than any premium Iran could ever collect. This brings us back to the core question: why would Iran make an offer they know cannot be fulfilled? The answer lies in the fracture of unity it causes among their adversaries. If Western nations accept, they admit that Tehran has a role in managing global trade routes. If they reject, they must find a way to guarantee transit without state actors from hostile regimes involved, which is currently impossible given the threat landscape. This dilemma forces every nation to make an independent calculation about risk versus sovereignty, and that independence is exactly what Iran needs to weaken the collective Western response. The strategic value of this bluff is not in its financial viability, but in its ability to expose cracks in the alliance structure. It turns a military problem into a regulatory one where the aggressor becomes a necessary partner in maintaining flow. The real cost is paid by the integrity of the international legal framework that has governed maritime transit for decades. Thanks for watching all the way to the end. I am a one-person team working hard to make each video better than the last. Subscribe if you found value. It is the best way to show support. Drop a comment with your biggest takeaway. See you in the next video.